Welcome back, folks. So I've had a lot of people asking about cover calls, how to do them, questions about them. So I'm going to go over that today, and I'm also going to go over a couple of examples, an entry and some profit on a cover call that goes your way, and then an entry and a roll on a cover call that doesn't go your way. All right. So the first few things that we need to understand about a covered call is in order to do a covered call, you have to own 100 shares of the underlying stock, right? That's the first thing. Second thing that you're looking for doesn't always have to be, but it really helps in your case, is to have a high implied volatility, right? And typically, the premiums that you're looking for on those types of positions are going to be 5 to 10%, right? So if I sell a short call, for example, on this stock Fastly, I've got it showing here at $71 currently. 10% on that would be 710 bucks, right? So I want to look for anywhere from 350 plus to 710 worth of premium on this. And that's kind of what we're looking for to profit off of what we've got leveraged, right? Um, the other thing is, let's see, if the stock price finishes in the money, and I'm going to jump ahead real quick here, just so that everybody understands this. One way this could play out is the stock price finishes in the money, it takes away your shares, right? So it expires in the money, your shares disappear, you keep the full premium that you were paid, plus the market's going to pay you for whatever strike price those shares got called away at. So let's say, for example, right now on Fastly, if I had my shares called away at $71, it would pay me 7,100 bucks. And if I got paid a $350 premium, I'm going to get to keep that as well. The other scenario is you take profits before expiration, or it expires out of the money. Right? In this scenario, if it expires out of the money, stock price will be below the $71 strike, and you keep the full premium that you were paid. So that's how this works. Right. So I'm going to talk about bullish and bearishness. Right? So in a bullish market, you generally want to use maybe a 1 to 2 week contract to take advantage of theta and flip those contracts as quickly as possible for about 15 to 25% returns, right? You don't want to get caught in an uptrend because you kind of want to try and take advantage of the stock price moving up and take some profits as it goes up. At some point you would want to sell that underlying stock for whatever additional profit you've made off the shares. So let's use this for as an example, and let's just say I'm looking for the stock to come to this shaded area, which is a gap. And I would say $93, $94 is going to be a resistance point. Right? In a bullish market, I would try to ride that stock all the way up and flip contracts every week, every other week to try and take advantage of the price rising and take in profits while it's doing it. Right? So you're kind of making money both ways. Right? But if it falls, if in a bearish market, we'd want like a 1 month contract, something that's around 30 days, give or take a week or so, 5 to 10 days, uh, simply because you're going to get paid more premium. And if you're in a bearish market, stock price is falling, it's just going to keep adding value to your position, right? So um, that's kind of what I would do in these scenarios. And I like to try to take 50 to 75% profits on a month contract that's bearish. You can kind of risk it and go to 80 to 90%. In my opinion, you don't necessarily want to do that, but if you do get to 80 plus percent, that extra 20% or less, if you're at 90, so 10%, if you're seeing that extra 10 to 20% is really not going to be that much, right? So I'm gonna do a little bit of calculation for you. So let's say you got $350 premium, and you're at 80%. That's $280. Another 70 bucks is really not so much in the grand scheme of things. So it's best to go ahead and take your profits while they're there because the market's always going to come back and take it away from you. or the probability at least is the market's going to take it back, right? So we're going to go ahead and jump right into a covered call. I've already purchased Fastly shares on the virtual on-demand uh, option or thing here. Um, I got them for $65. So I'm kind of cheating. I got I bought the stock right around here, 64, $65. So currently it's up $583. Right, break even 65.29. Current price is 71.29 or 71.12. And in this scenario, it's been hitting resistance in this area a lot. It's had a lot of bearishness, and earnings was on this day. I already know this, obviously, because we're in the future, but earnings was here. And as you can tell, earnings with this stock, typically it drops pretty hard. And it's gapped twice, or actually three times, right? So, it's something to expect here, right? So let's assume that it's going to do that same thing and gap. And it's going to, if it breaks below the support level, it's probably going to come down here, $47 area, right? You kind of look over here at the support. Um, so with that in mind, we're going to go ahead and purchase or sell a short call against the shares that we have. So again, 100 shares. That's what we currently have. So I'm going to go to the trade tab here. Go ahead and hit play on the market. So we're looking at um, this position right here. It's showing about $490 or so on the 72 strike. We'll just kind of let it tick for a little bit. Generally, like I've always told everybody else, you don't want to get something that's got a super wide premium here, right? So this one's about 140. This one's probably the better of the two, right? 625 minus 560, $65. Yeah, I like that one. We're gonna go with this one. So we're gonna sell this. Um, confirm. All right. So let's see what happens here. I might even go ahead and lower that price just so I can get in it. There it goes. Never mind. So it looks like I actually got it for $5.92, which is even better. All right. So now we're going to fast forward ahead and we're going to see what happens when the stock drops. All right, so I'm going to pause the video real quick and I'm going to go ahead and get the broker into the position so that you can see it. All right. So I've got it in the position here. Fast forwarded a good little bit of time, not too much. So I purchased on the 27th of April. It's the 3rd of May. The stock has dropped a few days in a row here. So we're going to look at the price of the contract and see what kind of profits we're looking at. All right, so 50% here. So it's had a few days of theta, but the stock has went in the direction we needed it to, right? So we're at 50% return, so showing about $297. Right, so this is ideal. This is where I would personally take profit. Right, I wouldn't expect it to break below the support level. I would personally say, you know what? It's at support. There's a lot of support levels here. I think I'm gonna take my profits. So simply, I would do this. Right click, create closing order, buy back for the price that it's at currently, confirm and send. And there we go. Right, it went even further. So we basically made, let's see, let's do some math. 592 minus 295, $297 on that position. All right. That's how you sell covered calls. You own the shares, you sell a short call against them, stock price falls, you take your profits. It's that simple. All right. Now we're going to move on to purchasing a contract, or I'm sorry, selling a call against some shares, and then it goes against us, and we're going to start looking to roll that position. All right, so I'm going to go ahead and pause it real quick, get the broker in position, and then resume. All right, so now we're back here. I've already went ahead and purchased 100 shares of Apple. um, somewhere around this area, 1124. Break even was 112. Already showing a really nice profit, 737 bucks. Okay, so we're looking at this point here where it looks like we got some resistance levels and we're hitting resistance. So, kind of just briefly looking at the chart, you would think, hey, you know what? Maybe we're at a resistance point. Apple still has some um, sideways movement or doesn't really have a lot of volume or something like that. Or today there's a lot of volume, which looks like there would be. So I would think, okay, maybe in the next couple of days or next couple of weeks, we're going to see some sideways movements and down days, right? So we go in here again. We're thinking we might see some bearishness or neutral uh, trading going on here. So we'd want to go for the nearest month contract that's 30 days or more, right? So that would put us in January 15th. So we're going to go ahead and go to January 15th. We're going to sell right at the money or wherever the OI is, and there's tons. So um, this spread looks great. So we're gonna actually, I would probably do the 125, another 250 bucks on top. I mean, that's the difference between these two is about 105, whereas the strikes are showing, you know, 250. So we're gonna go for this one. All right, so we're gonna go ahead and put that up for sale, and it sold it. All right, so go in here and look at the monitor tab. Drop Apple down. Okay, we've got our short call there. We've got our 100 shares there. So now what we're going to do is I'm going to fast forward real quick to a time frame where we're going to roll. And I'm looking at like, it's still a short time frame. It's going to be, about 8 more days in the future. But in my opinion, we'd be thinking, you know what? I think Apple's going to start moving up even further. So I want to go ahead and uh, try and get some more premium out of it and or roll up my strike, right? So I want to try and roll up the strike. And that's generally the best way to do it, in my opinion, is to roll that strike up so that you can follow the stock price up and take advantage of the actual underlying share price and, get your profits there, plus take in some premium, right? So we're going to go ahead and move forward to the day that I've already chosen, which I believe is the 9th. Let's go ahead and jump there. I'm going to go ahead and just leave this as is. Actually, I'm going to pause it so I can make sure that everything's ready. All right, so I've got it set up here. Typically, when you do a roll, you need the market to, or you need the stock to fall, right? So that it builds premium on that contract. So when you do the roll, you can get more for it, right? So I've set it up so that we got a pretty good red day here. And, in my opinion, um, you've seen the stock price jump above this resistance level and hold that area. So we start looking for a good pullback that's going to bounce off that resistance level that's now acting as support. And this is going to be the area that you're generally going to try to roll your contracts, right? And when we roll, we're going to be looking to roll the nearest contract forward, right? So let's just take a quick look. First thing I'm going to do is go to the next contract, which is this one. So you can see my position is on the 15th of January. The nearest contract forward is going to be on the 22nd. All right, so right now we have the 125 strike. So I'd go for the most open interest. And this is a weekly as well. As you can tell, the OI just isn't really there, right? Now let's just take a quick look at February monthly. It's going to be, see the huge difference in open interest, right? So in this scenario, when you roll, you're going to want to go for something that's got the best open interest, right? So here, we're going to roll out to this strike, 130. So that's going to give us another $500 in profit plus this premium here. Okay, so let's go ahead and do that. I'm gonna go ahead. I'm gonna pause it real quick, get this set up, and then come back. All right, I'm back. Here's a perfect example of not being able to roll to the 130 because of it requiring a $114 debit. So in this case, we'd try to go to the next week after that, or the next contract, which is going to be the February monthly. and that's going to give us $90 in credit, right? So what this does is the initial premium that I took in, which was 392, it's going to add 90 on top, right? So 392 plus 90, that's 482. So that's your total maximum profit ability plus the underlying value of the stock if it hits 130 and gets your shares taken away, right? Now, some of you will be asking, well, how do these two numbers add up? And how is this only 90 when the contract itself is saying 275? Well, um, to try to make it as simple as I can put it, when you initially sold it for 392, it's currently worth 275. It's going to basically take the difference between, so you're basically having to buy this position back right now. So that contract, 15th, 125, is 390. Okay. And you're selling something ahead in time, right? So when you do that, you basically keep the premium that you've got, and then whatever it costs to roll that out, it's going to subtract that much, and then whatever the credit that's an addition on top, it's going to add it to the previous amount, right? So I'm going to confirm and send that. I'm not sure if it's going to allow me to do this here on the virtual platform. Now, hopefully I didn't confuse anybody with that explanation. I guess it would help to hit the play button. And there it goes. Okay, so now you're seeing there's my actual trade price. And remember, 482 is what I calculated. 392 is what I initially got. 90 is the additional credit received. I rolled my strike up to 130, right? And that's how I got the 482 trade price. So basically bought and sold this. Whatever the credit on top was, it added it to my original contract, which makes it to be $482, right? So not only did I take in a credit, I also rolled up my strike. So when the stock price, um, was at, the $122 area, so like I purchased it for 112 and went up to 122 something or 121. Currently worth $897. That's the current value here. If it calls my shares away come February 21st, I'm gonna keep $482, and you're gonna add whatever the price of the stock price of 120. Let's just round it up to 122. Okay, so 122. So that's $800 at 130. So 800 plus current value of 898. That's how much the shares will be worth plus the premium that you got paid, which is 482. That's your total profit if those shares get called away on the 21st of February at the 130 strike. That's your total profit, right? So now the reason why I choose to roll is because, again, you think the stock is bullish, right? So this is a perfect example of how to manage a covered call to take advantage of both the share price value and take in additional premiums on the contracts. So you're basically getting paid in two ways here, right? So hopefully that helps everybody understand how to go about doing this. And I could go through the concept of closing out this option position and then selling the shares, but I think you guys understand that. So again, if anybody has any questions, feel free to reach out. Happy to help. And I hope this clears up everybody's questions and confusion. So again, talk to you later and have a good night.